Okay, so we've spent the weekend digging through the research for you. We took those stacks of institutional strategy notes, the technical damage reports, and we pulled out the only numbers you really need to be watching tomorrow morning.
And our mission for this deep dive is pretty simple. We need to distill those key technical warning signs, identify the one macro theme that's driving everything, and then pinpoint the volatility triggers on the calendar for 2026.
It's essential right now, isn't it? We're at this really critical point where you have ultra-low liquidity meeting these fully priced-in optimistic expectations.
Exactly. Institutional conviction is, it's basically gone for the holidays, but the market momentum is just stubbornly high. So we have to identify the consensus zone, what everyone thinks will happen.
Because that's the setup for the pain trade.
That is the exact setup for the year-end pain trade.
Okay, so let's define that consensus. We have to start with the rear view. Last week's close, it was a definitive bullish extension.
No question.
The S&P 500 gained 1.4%, the Nasdaq climbed about 1.2%, and we punched a fresh intraday all-time high on the SPX.
And that number was 6,929. That really just underscores the sheer momentum we've seen in 2025. You have to acknowledge the strength.
It's the 8th straight monthly gain.
The 8th consecutive monthly gain for the Dow and the S&P. Momentum is undisputed. The narrative's rarely been better.
And this is the big but in all the research, the real risk is what that strong close was masking. The volume. All the reports highlight the thin holiday volume. It's a strong move, sure,
right,
but it completely lacks institutional conviction. It feels more like a retail and algo float.
Not deep-pocketed accumulation. And that lack of institutional support is exactly why the weekly technical damage report shows this deeply bifurcated market right now. If you zoom out to the weekly time frame, it tells two very different stories.
Okay, so what's story number one?
Story number one is the SPX. That's a clear yes. It held its multi-year ascending trend line. The technical posture is still a melt-up, and it's pinned right near that big psychological 7,000 level.
But wait a minute. We just hit an all-time high. So why are the reports so obsessed with downside risk right now? What are the defensive levels we should be watching?
That concern comes entirely from the Nasdaq, the index. While the S&P is melting up, the Nasdaq is, it's stalled.
Stalled how?
It failed to clear the 25,284 resistance zone, and that failure, that indicates clear exhaustion compared to the broader market. It means the heavy lifting is being done by large cap value, not tech.
So if that Nasdaq stall has the institutions worried, what are they, say, 3 non-negotiable key pivot levels that define success or failure for this week?
Okay, first, for the SPX, the line in the sand is 6,850. If we lose that on a weekly close, the whole Santa rally structure is just invalidated.
And that opens the door to what?
It opens the door for the market to aggressively seek 6,500 in January. Second, for the NDX, primary support is 24,500. A breach there is a major signal to rotate out of growth. You'd be risking a swift 5 to 10% drawdown in semis.
So those are the internal equity risks. But the tether that connects all of this, the momentum to the stall, has to be yields. That's the third critical number.
Absolutely. The U.S. 10-year Treasury yield is climbing, sitting near 4.14%. The critical threshold everyone is watching is 4.10%.
And why 4.10% specifically?
Well, staying above that level keeps real pressure on tech and growth valuations. It raises refinancing costs, it lowers the present value of future cash flows, all of that. But if the 10-year drops below 4.0%, that would be the green light the Nasdaq needs to clear that resistance and finally catch up.
Okay, so yields putting pressure on tech valuations, that brings us right to the big macro story that's dictating everything right now, the soft landing victory lap.
It is a spectacular contradiction, isn't it? It defines this market. On one hand, U.S. GDP is running hot at 4.3% pure economic strength.
And on the other hand,
the Fed is cutting rates into that strength. They're basically guaranteeing the soft landing. And that narrative is driving all the rotation, pulling money out of pure AI plays and into basic materials and value.
And this entire rally, even with all the excitement, is fighting against a valuation ceiling. We're trading at a high 24x forward PE. That's not cheap. So why are institutions ignoring that risk?
They're not ignoring it. They're just refusing to take the trade. It's the ghost week trap. The COT report shows leveraged funds are at a 3-month high in neutrality. Conviction is at a 52-week low.
So nobody wants to risk their 2025 bonus.
No one. Not on a low liquidity trade right before the books close.
You know, what's fascinating here is the psychological setup versus the technical reality. Technically, the S&P 500 RSI is 54. The notes call it no man's land.
Exactly. We're not technically overheated, but we're definitely not cheap either. Prices aren't at extremes, but psychologically, the market is overextended on complacency.
Complacency.
The VIX is suppressed, hedging costs are dirt cheap. No one is buying downside protection because the expectation of continued smooth sailing is just completely priced in.
And that raises the question, what happens if that expectation gets challenged, especially with skeleton crews on the trading desks?
Well, this is where the setup gets truly dangerous. The consensus is clearly sideways chop for the next few days. So the ultimate pain trade is a sudden, violent move higher, a melt-up squeeze.
The setup sounds classic.
It is. Desks are staffed by junior traders with automated, tight stop losses. If a little positive momentum triggers some concentrated buying, which doesn't take much capital in this liquidity vacuum, it forces all that sidelines cash to chase performance.
And all the patient bears and bulls just get left behind.
They get burned trying to catch up before the January 1st reporting deadline.
That makes the upcoming calendar events even more critical then. Institutional money is going to come roaring back after New Year's, and they're going to demand some direction.
Yes, and they've mapped out a volatility minefield for that first week of 2026. The entire market needs validation for this 8-month winning streak. The first big event is the FOMC Minutes release on Tuesday, December 30th.
Right, because the market just absorbed the Fed's third 25 basis point cut on December 10th.
Exactly. So traders are now hunting for the terminal rate roadmap. They're looking for any sign of division within the committee about whether they pause the easing cycle in January or just keep going.
Okay, so then moving to the midweek check, we've got event number 2. JOLTS Job Openings on Wednesday, December 31st.
The job openings and labor turnover survey, the Fed's favorite metric for labor market tightness.
And the reports are flagging this as pure binary risk.
It absolutely is. If JOLTS comes in hot job openings way above expectations, it means labor demand is fierce, wages stay sticky, and that higher for longer story gets its teeth back. Stocks pull back, yields spike.
And the 2026 cut gets pushed to Q2.
Instantly. But the tightrope walk is the other side. If JOLTS comes in cold, that validates the soft landing, which could be bullish. But there's a tipping point. The reports flag a potential recession scare if the number drops below 7 million.
7 million is the magic number.
That specific level would signify a break in the demand structure that the Fed has been counting on.
Okay, then we hit the heavyweight data on Friday, January 2nd, a doubleheader that will set the tone for the entire first quarter.
First up is Event 3, ISM Manufacturing PMI. This is the health check on hard goods, and it's hovering right near that critical 50 line.
The line between contraction and expansion. So what's the trading implication there?
If PMI prints above 50.5, that's clear expansion. It fuels the no landing scenario. Great for earnings, but terrible for rate cut hopes. Yields would surge.
And if it prints below 48?
Below 48.0 is a strong contraction. That triggers a full-blown growth scare, and you'll see an immediate flight to safety in bonds and gold.
And then, of course, the data point that always causes the most whiplash, non-farm payrolls and unemployment on the same Friday. What's the biggest risk there?
This print decides everything. A strong beat, say above 200,000 jobs with falling unemployment, that extends the Goldilocks story. Stocks rally on pure strength.
But a big miss.
A big miss, below 100,000, combined with rising unemployment. That's panic stations. The market would immediately price in aggressive emergency cuts. This single report, more than any other, decides if the S&P 500 breaks to new all-time highs or confirms a double top.
So what does this whole roadmap mean for tomorrow morning's opening bell? I mean, the institutional advice seems crystal clear.
Stay light until that Friday volatility minefield is cleared. We need to focus on the sectors that are most exposed to this calendar risk.
Which means looking at where the yield curve pressure is strongest.
Exactly. The sectors that are hypersensitive to the yield curve are your pressure points. Regional banks, the KRE, and small caps, the IWM, they will be the first to react.
So if the data is so binary on Friday, what's the linked outcome for those sectors? What's the trade?
If Friday is hot, strong jobs, high ISM, the 10-year yield rips higher, that scenario just crushes small caps. IWM gets hammered because all those highly leveraged companies get hit with higher refinancing costs.
And the flip side, what if the data comes in cool? Weak jobs, soft ISM.
If the data is cool, you see a bull steepener in the curve. Short-term rates drop faster than long-term rates, and that is the Goldilocks zone for regional banks. For KRE, their net interest margins stabilize, and they can finally breathe.
So it sounds like the whole game plan is just extreme patience. Don't chase the SPX 7000 print on zero volume. Stay small until Friday.
That's it. The two core conflicts are bullish price action versus low volume and conviction, and the soft landing narrative running headlong into high valuation risk. The big money is waiting for the calendar to either validate this trend or, well, liquidate it.
And that waiting game leads to the biggest risk, doesn't it? The suppressed VIX, the cheap hedging. It's all screaming complacency.
That complacency is the biggest danger heading into 2026. The market is not technically overbought, but it is dangerously overextended on the expectation of continued smooth strength.
So that brings us to the final thought. The institutional research all notes that the market is waiting for a January dip to buy. Everyone's waiting for it.
Everyone. So here's a question for you to think about. If the pain trade, that sudden, violent melt-up, is triggered this week on low volume, what is the consequence for your Q1 strategy if you are forced to abandon your patience and buy the top instead of the dip you waited so long for?